All right, everybody, welcome to Brighter. So Tesla has cut prices yet again, this time across the board on all new Model 3s and Model Ys in the US this weekend. This is on top of Tesla introducing a new Model Y rear-wheel drive entry-level vehicle priced at $43,990. So with all these price cuts happening since the beginning of this year, there is a lot of misunderstanding out there. There's people who think that these cuts have not increased sales. There's people who think that these cuts will show massive reductions in margins for next year. So today we will review the actual prices of these cars since they were introduced, and more importantly, what has happened to cost of goods over time. We have Jeff Lutz with us to join us to explain all of this. Jeff is a supply chain C-level executive who worked at Motorola, Google, and Lenovo, and he's currently running his own consulting firm. So welcome, Jeff.
Great to be with you. Let's get after this.
Yeah, thank you so much, Jeff. So you are actually a perfect person because of these misunderstandings. You know how price cuts impact margins and the cost of goods. We're going to walk everybody through that. You've prepared a presentation for this. So let's just set the stage and let people understand what's happening. So first of all, this weekend, they cut the prices of the Model 3s in the US yet again. So about, looks like here, a couple $1,000 for all the different Model 3 prices. They did the same thing for the Model Ys, again, a couple $1,000. So this is right after the quarter ended, where they were giving a lot of kind of rewards to try to increase sales. And then they cut the prices after the quarter. So you would think that they would cut prices before the quarter ends because they're trying to sell more, but they did it after. So I want to ask you about that. And then this is on top of just last week, they introduced a new Model Y entry level, which is $3,750 less expensive than the base model that they had previously, which they discontinued. And so now these prices have all gone down significantly. So some people are saying this, Jeff. They're saying that, look, the Model Y is an example, but across the board, Tesla's been cutting prices significantly. So if you look at the Model Y in December 2022, the beginning of this year, it was $65,990. Now it's at $48,490. That's 25% reduction. And people are afraid you're cutting prices. Why are you doing that? There must be demand issues. What's going on with the margins is going to be a major hit. Why don't you address some of that?
Yeah, let's get into this. And we'll have a couple of graphs to go through in a bit. The first thing I want people to do is just to take in context what just happened. So we get this alert on Twitter that says there's been price reductions, and you look at it, and let's break it down very succinctly. On the Model Y, there are three trim levels or three versions that ship in North America. There's a newly introduced rear-wheel drive. We'll put that to the side for now. That was introduced at a new, lower price. There's stuff pulled out of that car. Tesla did not introduce something at a price point where they're not going to make, their gross margin targets. Let's just hold that there. That was a purposefully introduced new model. That's the rear-wheel driver, and that's a lowest cost variant. The other two that they cut are the long range and the performance version, $2,000 each. Okay, so the first thing you have to do is you have to understand the scope of the MSRP change. That's what we have to do. Tesla's a global company. They ship cars everywhere. This was an announcement about North America. In North America, about 28% of the Model Ys, you can round up to 30 if you want, but 28% of the Model Ys that Tesla ships globally are shipped in North America. So the first thing you have to do with these price cuts is you can't say it's $2,000 for every single Model Y that Tesla ships, which is its number one, volume driver. It's only in North America. So now you have 72% of it that's not touched. And by the way, there were some countries in Europe that actually raised prices a bit, probably for currency. Now you're back in the US and you've got 28%. Now there's three trims now inside of that 28%. One of them, which is the new lowest cost variant, was not touched. It was introduced at a price point and it wasn't touched. So you have to think going forward, if Tesla's going to run roughly, call it 25 to 30% of the Model Y shipped globally out of North America, and that's going to be the path going forward. But two of those trims took a $2,000 price cut. So let's give it a worst case, even though I think the new rear-wheel drive variant is going to be much higher in volume, than the other two. Let's just say that that new variant, it takes off 8% of the 20%. So now 20% of the vehicle, 20% of the Model Y shipped have a $2,000 price cut. So what you immediately have to do is you have to take $2,000 and multiply it by 20%, because that's the actual MSRP change that global Tesla is going to experience. So when you do that, it's a $400 MSRP reduction. So I just want to repeat that. Tesla did not reduce prices on Model Y globally. They reduced it on Model Y in North America on 2 of the 3 variants that they ship. And those 2 variants are probably going to be in the area of 20% of the Model Y shipped globally. So when there's a $2,000 price reduction, then you have to take that to normalize it and make it an aggregate. You've got to multiply it by 20%, and that's roughly $400 then across the population of Model Ys that Tesla ships globally, that Tesla then has to go and solve for in COGS. Same discussion, but briefer on the Model 3. On the Model 3, it's roughly half of the Model 3s are done in North America versus the rest of the world. So there was a $1,250 price cut in North America on the Model 3s. So when that happens and only half of them are shipped in North America, you multiply that and you get, the 625 basically is the aggregate reduction on Model 3, again, globally, that Tesla has to go solve for. So in aggregate, off of pricing, again, globally, the 400 and to 500,000 now cars that Tesla is going to build per quarter, they got to go solve for somewhere in the area on 3 and Y of, call it $400 to $600 that they have to go solve for. Remember that, because it's going to be important when we go through and step through the COGS slides. If we can pull that back up, Herbert or Advance, we can get into that.
If you can, please consider supporting this channel. It's a lot of work arranging all of these amazing interviews. I've created a website that is the most comprehensive resource for the Tesla investor. It has over 15 modules to keep you informed. Please check it out. Simply go to my website at herbertong.com. Thank you very much, and let's get brighter. Yeah, we'll get into that. I just want to ask you the question of why are they reducing the prices? So there's a lot of people who think that these cutting the prices is going to impact the margins. You just said it's actually not as much as $2,000, it's $600 or even less. We'll get there. But before that, why did they cut the prices? So I wanted to show this, which a chart you've actually been saying and repeating for a while now, which is that Sam Corris from ARK Invest put this into a chart form. This idea that the prices of Tesla's cars have actually are basically the same as when they first started, when they were first introduced. So on the left here is the Model Y pricing history for the Model Y, and the right is the Model 3 pricing history. And you can see here that since March 19, we're just back now to the same price as what it used to be March 2019. And so people keep thinking that the price was so massively cut in the beginning of this year, which it was. But there was this temporary boost up, which you've explained is because of COVID supply chain issues and all these other concerns that happened last year. But the same thing happened for the Model 3. So before we get to the cost of goods, can you just explain why they're cutting prices?
Yeah, it's a great question. In a product's life cycle, the worst COGS that a product will ever experience in its life cycle, let's say it's 6 years or 10 years, the worst COGS are going to be in the first 1 to 2 quarters of launch or anything built pre-launch. That'll be the worst COGS ever. Now, when you have a supply shock, when you have a once in 100 year pandemic like we have with COVID, what you saw there on the graph was there was a bit of a spike up a couple of years into the life cycle, especially of the Model 3, and that was the COVID supply chain issues. And then Tesla had to take their MSRPs up accordingly. But in the life cycle of Tesla, all what Tesla's doing is they're returning back to their original MSRP points from several years ago. However, their COGS have deflated significantly since then. And that's the key. When you launch a product, your COGS are the worst at launch, and then quarter by quarter, you are doing what's called event-driven reductions, and you've got quarterly declines that you're grinding out of your supply base and your factories to take your cost structure down. So Tesla's returning prices back, what they sell to people for, to where they originally were at launch. But over that time, they've been able to drive up efficiency, improve efficiencies, and take their cost structure down.
Okay, let's talk cost of goods now. So this is one of your tweets that you've been replying to folks, and let me break this
Yeah.
down to what I
eh,
understand you're saying. Go ahead.
Yeah, yeah, and I was just trying to break down what I described earlier, which is when there's a $2,000 price drop, you've got to normalize it to the region the price drop was in and what kind of volume is needed. So we really only have to drive about in this case on Model Y, about a $400 reduction in COGS and close to a 600 on the Model 3. But I think Tesla actually targets, 4 times that in their list of actions. And what I mean by that is there's 3 or so main chunks where Tesla goes to get money for COGS and to take it down.
Mm,
One is they go to their supply base,
right.
and they have been the best OEM in the world. Like, suppliers should be giving Tesla an award for how well they treat them in terms of giving them volume forecasts and pulling all the material, not sticking them with a bunch of excess. I'm sure there's issues, but in general, Tesla is a model OEM when it comes to giving forecasts and then taking all the supply from all the suppliers. When you're a supplier and you're doing business with Tesla, you can depend on them. So one is they go to their suppliers. Two, their gigafactories, they work on efficiency improvements every single day. They never stop. Every quarter, they are improving basically what they're improving their output per person, and they're improving their output per capex or capital usage in the factory. And they're also improving their output per square meter, which we may talk about it a bit later. But in general, they're getting more efficient in the gigafactories. They have gigafactories that are more mature, like Shanghai and Fremont, where they're more squeezing things, and they're doing event. Well, I'll get to the third thing in a minute, but in general, they have more efficient gigafactories, and they have ones that are probably well under the curve of efficiency, like Berlin and Austin, where we'll see in a minute that they're probably a couple $1,000 drag on COGS. So they have a lot of room under the curve to improve. And then the third thing they do for COGS is something called event-driven cost reductions, where the Tesla engineering team says, "Hey, I can take these 2 parts and I can combine them," or we can go to the supplier and this testing that they're doing, they don't have to do this particular test anymore because it's never failed, and we have structural coverage somewhere else. Or we want to introduce a new lower cost part, or we're going to take this bonding step out because it's covered here. These are event driven things where there's a plan, there's a trial, and if it works, it's literally like deleting a process, reducing the time a process takes, or reducing the amount of raw material that's needed for particular areas. So 3 things that they do: suppliers, gigafactories, and event-driven reductions. That's how they go after COGS. And I think Tesla, while they need this, remember this $400 to $600 to deal with these price cuts just experienced, I think they're driving 2 to 4 times that at a minimum.
Okay, so interesting. So in your mind, the reason they're cutting prices is because they can. They're able to reduce costs, and so they want to transfer some of that back to the customer. Let's go ahead and walk me through again the details of what's going on here. Let's show your slide that you put
Yeah.
together here.
First thing is, when Tesla reduces MSRP, you have to understand the scope. And I walked through that example again of the $2,000 off, the 20, in the US only, it's 28% of Model Y globally. It's 2/3 of the trims. It's probably 20% of the Model Y is discounted. And that's how you get to,
Mm,
$400 in aggregate. And this is the other thing is you can look this up too, but from my experience in supply chain tech companies, I've supplied auto companies, I've studied auto companies now. They should be driving 1.5 to 2% alone, actually from their supply base alone, and then they're driving factory reductions on top of that and event driven reductions.
every quarter.
And Tesla does better than this consistently under normal. When I say normal circumstances, you'll see there's a couple of abnormal spots, but in general, they do as well or better than this. And I think I think they have actions that drive, like I said, probably 2 to 5% per quarter And if you just get to the 2%, you're probably taking out $750 to $800 per quarter. And so again, when you deal with a $400 reduction on Model Y, and if they can just get to the 2%, they're taking 750 to 800. So this is why I think all MSRP reductions aren't created equal. The ones that were done in January and April this year, this was resetting where pricing needs to be post COVID. Okay. And this is also resetting where pricing needs to be with, 5%, 5.5% Fed funds rate hikes, in the fastest ever. So that was more of a reset. Those were big numbers. Those are $4,000 to $6,000 or more. And those were across everything globally. And now what you've seen Tesla do since April, less frequency of MSRP reductions, and they're only doing them regionally, and they're doing them on select trim types. So it really, and then the actual aggregate value, the 2000, is much lower than what they were doing in April. So Tesla's really they're coming into what I believe are the final innings, and they've basically allowed their supply chain and engineering teams to catch up, where the COGS decline curve is really going to start catching this. We hear Elon talking about like it's not going to matter. This is all going to be handled by robo taxis and FSD, but you don't. I truly believe that they're intently focused on hardware margins as well, and they want to minimize their hardware cost as much as possible and basically drive the effective value of that, theoretically as close to zero as possible as autonomy ramps up. So they're going to be relentless about this. We'll go through this I think in the next chart. It'll
Yeah.
really start to
So
spell it out.
first of all, I love this table. Thank you so much for sharing this. This is the first I've ever heard this, and I've learned something new today. So you're basically sharing that on average, an auto company should be driving 1.5 to 2% of cost of goods decline every quarter. And so you said a 2% decline per quarter can be $750 to $800 for every 3 and Y. That is an amazing stat. That that gives me a little bit more understanding of how much I should expect that the margins can go up if they keep the price there, or why they're able to reduce prices by these, like you said, you got to put things in scope. Okay, tell me about this table here. It looks like it's from 2020 Q1 to 2023 Q2. You're looking at prices. Oh, tell
Yeah.
me what I'm looking at here.
Yeah. So this is from, I want to credit Troy Teslike on this one. I put it at the bottom left as well. And I annotated this slide a bit. So this is an estimate of what is believed, Tesla's COGS are on the 3 and Y. Again, why do we talk about the 3 and Y? The 3 and Y is 96% of what Tesla is shipping. So it really drives the story for Tesla. And what I did, I put three light green arrows on this chart, and they basically represent four or so different quarters sequentially in a row of what Tesla does. And basically each one of these lines, if you look at it, so go from 40, the first line on the left goes from
Right,
41.2 down to 37.3.
right.
The second line goes from 38.2 down to 35.2. The
Mhm.
third line goes from 39.8, basically down to 36.5. What's Tesla doing in each one of these progressions? They're doing what I told you they would do, which is basically they're doing about a 10% drawdown in
Mm,
COGS on an annualized basis. Now, what are these special things that are happening? Well, if you look at Q1 2021, there was a bunch of weird, you see some, you see in the first line and second line, there's a couple of, increases in COGS. Well, what's happening there? That's all the COVID stuff that was hitting Tesla left and right, I'm sure. Tesla can't avoid if a container goes from $1,200 a shipping container to $18,000. They can't avoid those things too much. They don't buy all these things on spot pricing. They have longer term contracts, but at some point they're going to get hit with some of these COVID issues. But there's a second spike on that chart, Herbert, and that one was when Berlin and Austin were activated. And I want people to understand that, and Zach even mentioned it's the 35.3 on Q1 2022. If you go down to Q1 2022, you'll see that there's a spike. It goes from 35.3 to 39, and that's
got it.
basically Tesla ramping and starting up these Austin and Berlin factories.
Mm,
And I want people to
got you.
understand the magnitude of that. That
Got
it's
you.
probably it was $4,000 of it was a 10% drawdown on again. This is their worldwide COGS. You can imagine what the COGS are in those specific sites for Austin and Berlin. This was the drag on worldwide COGS. You have this super efficient Shanghai, and you got this relatively efficient Fremont cranking all the volume. But this is why Elon said that those two
Mm,
factories are a furnace. So I believe that they've cut that probably in half, and then they're still probably a couple of $1,000s that they've got to work through in efficiencies, especially with Austin and Berlin. But in general, they've taken that down. And then you've seen this last drawdown, they've done another 10% drawdown in COGS annually. So Tesla consistently is hitting this. You have some of these abnormalities that happen abnormalities that happen, whether it's again COVID or again bringing on the new factories. But in general, they've got a history of consistently driving this cost reduction. So this is why when I look at just take one quarter, just take
yeah.
Q1 2023 to Q2 2023, and what did they
Yeah.
do there? They did $2,200, $1,200, sorry, of COGS reductions. Again,
Mhm.
you know, and if you look at their total COGS, they did roughly 3 to 4% in that one quarter of COGS decline. So this is why when I see a model, going back to the example, why I see a $400 in Model Y, I don't get overly concerned, and I think they could actually do more.
I love it. Okay, Jeff, you are amazing. So this is information that I think me and many people just don't remember. I know Gary Black doesn't think about these things. Based on his comments, he goes every time there's a price cut, he's very upset because he basically changes his gross, margin expectations for next year. Institutional investors do that. Stock price goes down, but you may not need to necessarily bring down that much because margins may not go down that much next year because you're showing and you're reminding us that, listen, you can expect the cost of goods going down quite regularly every quarter. And so whenever you see $1,000 reduction here and there, much of that could just be, like you said, the price versus the margins of that is $400 versus a couple thousand. But the interesting thing about this table you just showed is amazing is that rise here is because of two gigafactories coming online. And so
Yeah,
if those gigafactories weren't coming online, or another way to put it would be once those gigafactories have become fully scaled up, we're going to go below the 35,000 at some point in the
yeah.
future. This
Yeah,
is
there's no
exciting.
reason they're not gonna do another. There's no reason. I know Tesla told Deutsche Bank that, there's gonna be some slowdown in cost. There's no reason why they can't do this again, and this is why. I keep going back to these fundamental things that Tesla is doing. They're driving increased volume quarter on quarter. Yes, they had the shutdowns this past quarter. What are they doing shutdowns for? They're making their lines more efficient. They're getting their lines ready to build product at higher gross margins and lower COGS, like the new Model 3 Plus, for example. So, uh, I Tesla, there's nothing that Tesla is doing. They're continuing to. They're not pulling their volume. Think of what Ford, GM are going through right now. They have plants shutting down. They've got to tell suppliers that, hey, we don't need all that material, and then these suppliers have to lay people off. Like, it's a mess right now. But the Tesla supply chain is like, give me everything you can have. And this is the big thing. Going from Q3 to Q4, where Tesla only built about 430K this past quarter, I think they're going to target at least 500K built this quarter. So they're going to their suppliers are going to see a big jump up in demand quarter on quarter. And what happens when you're building more volume? You get more efficient. You get more efficient. Tesla's going to have their hand out asking, to have some of those efficiency improvements from their suppliers. Because again, they're giving them the opportunity to produce more volume. And one more thing I want to say is, it was correct, though, earlier in the first half of this year when Tesla was doing those gigantic $6,000 across the board price cuts, that their COGS decline was not going to keep up with that directly. And that's why you saw the
Right.
gross margin compression in the first half of this year. All I'm
Mhm.
saying is that is slowing down now. And now I think in this quarter coming up, this Q3 is going to be messy. You have the inventory units, you have the shutdowns. I don't know what's going to happen with factory costs in that one. Hopefully, they found a good way to contain it. But in Q4, what I'm saying is volumes are going to be higher, and there's no reason why they can't continue to march down that COGS decline curve. And again, they're doing smaller, less frequent regional price cuts, not across the entire population.
Okay. A couple more points to make here. This is a fantastic chart put together by Bloomberg showing that if you look at the dotted line, that's the US average for prices of new car sales. And the green is the Tesla Model Y, and the black line is the Model 3. And you can see that the Model Ys are actually now lower than the average new cars prices out there, and certainly the Model 3 is as well. So the Tesla cars are now lower, and they are killing it in terms of EVs, the sales of EVs. You can see that the percentage of EV sold has risen to 61% of all EV sold in the US, and it's, pretty significant. So let's take a look at what Gary Black thinks about all this. And he's an analyst who has kind of thinks of it like an institutional firm does. And what he's saying here is that, he thinks that price cuts have not caused any increase in volume sales, and in fact, just causes average sales price and gross margins to fall. So he said that despite the year to date price cuts, Wall Street still thinks that the Tesla deliveries for 23 and 24 are going to go down. So despite the price cuts, the deliveries will go down because the ASPs and automobile gross margins were reduced at the beginning of the year. There's no price elasticity. Then he also makes the point that why is it that in the US, the SAR, which is the amount of global, not global, but I guess all the cars sold per year, is actually rose 15% with the same interest rate increases. So everybody who thinks that the interest rates is causing people to buy less cars is not true when he looks at it based on total US car sales have gone up by 15%, he says. So he thinks that price elasticity is just not happening and it won't happen for luxury goods. Just because you've reduced the price of a luxury good, it's not causing people to buy more of it. And he believes that you should be doing more of these marketing levers like advertising and so forth. And then he's just pointing out that this is the deliveries estimates by consensus of Wall Street, that it's really gone down and not gone up based on the price cuts. And then this is meanwhile, the average sales price and the gross margins have fallen. And that's why institutional firms are lowering their price targets for Tesla, and they're not happy because of gross margin estimates for next year. Omar from Homars replied to him, and I thought he had a very articulate way to explain it from our perspective. If you had not cut the prices, the estimates would have gone down. So even though they stayed the flat, if you did not cut the prices, they would have gone down. And then he also said that the reason why the total sales of cars in the US have gone up is because you're comparing it to the pandemic auto shortages, which didn't affect Tesla so much. What's your explanation for this, Jeff?
Yeah, well, it did affect Tesla, but Tesla was faster and not effectively, it didn't, but Tesla was faster at responding. But yeah, this is a point. There's a couple of points to pull apart here. First off, we're lucky to have Gary Black in this community, really kind of pressure testing what we're thinking, what management's doing, and really kind of coming up with his own estimates and his own models. So I appreciate the work he does. A couple of things. So let's talk about elasticity. When you measure elasticity and you only include two variables and you exclude other variables that are meaningful, I question a bit the analysis. And there's a couple of variables that are meaningful. One is the Fed funds rate or the auto loan rate. And for some people, it's like, oh, it only changes the average car payment $100 a month. Well, if you do $100 a month over the price of the loan, you've got several $1,000s. And so that's one of the drivers for Tesla doing these price cuts, is to take that burden off the consumer. The second thing you have is inflation. Everything costs more. And you're saying, well, why isn't Tesla raising the price of their car? And other automakers have, or they've been able to hold their ASPs. What's happening there is that's the second variable in elasticity that's not being included when people just say, hey, look, Tesla lowered their prices, but they're still on the 1.8 number. Well, if you don't include inflation, meaning everything else that everybody else buys, their food, their clothing, whatever else they buy, their homes, everything else costs more. and it's consuming their total budget, then they have less money to spend on a car. So I struggle with these elasticity comments I see on Twitter. I don't think we know the answer until we can understand the effects of those other variables. I think, and I agree with Omar, that if Tesla didn't reduce pricing, the volumes would have come down significantly. And you remember that COGS chart we showed of the impact of Austin and Berlin when they were at very low volume starting up. It was several $1,000s of COGS impact per vehicle. If Tesla's volumes were to decline to 1.5 or 1.2 instead of the 1.8, and just they were to hold pricing more and try, maybe try and experiment some other things, I mean, their fixed costs would have caved in on top of them, and they wouldn't be able to go to their suppliers and say, hey, I want my 1.5% from you at least per quarter on quarterly COGS reduction. So there's a lot of implications by saying just try to hold pricing more and try other things. I think Tesla is taking more of a first principles approach. And then on this elasticity piece, I think we're missing, if you just do price and volume, you're missing inflation and you're missing the Fed funds rate and the impact on the effective auto loan per month cost for consumers. One
Thank
other
Mhm.
comment, maybe we'll pause there for Herbert if you have a comment.
I just wanted to thank you so much, Jeff. There's just so much information you shared here that people don't get anywhere else. Yeah, go ahead. Finish your
One
thought.
more comment on the auto SAR. Gary made a comment of, hey, look, the auto SAR. So the SAR is or the wholesale. This is how many cars that auto manufacturers ship to dealerships, basically,
Mm,
and that's an estimate. It's an aggregate of all the. This is a U.S. number, and the U.S. number's up about 15% year on year.
mm,
And a lot of people have been surprised at that all year. Why is that happening? Especially what's happening with auto loan rates, inflation, and so forth. And if you look at the past 3 years, the non-Tesla U.S. auto manufacturers have been, their volumes are way down in the past 3 years due to COVID. They struggled to recover, or they purposefully didn't build out as much because of other issues. But basically, they, from the chip shortage and other supply chain related shortages, they were much slower to recover than Tesla was. So they were supply constrained the last year. So if you compare their demand or their SAR from last year to this year, you're saying it's up 15%. Well, they were supply constrained on their SAR. That's why they couldn't sell as many units the prior year. So a proper comp would be to do it to 2019 pre-COVID. And what you'll find is they're down. The SAR in 2019, I believe, was 17.5 million units. They're down at least 10% in the United States. And over that same period, from 2019 to now, Tesla went from, I think, 367,000 shipments in 2019 to the 1.8 today. So Tesla's up, 5x, and the rest of auto SAR is down, which includes Tesla, by the way. The rest of the other auto is down 10% pre-COVID to now. So that's the proper way, I think, to do comps in this situation, not to a supply constrained view, which is Omar's point as well.
nice. Thank you so much, Jeff. Okay. Again, you blew my mind twice today. There's so many information here about the cost of goods, what to expect in reduction in prices, the cost of the goods every quarter. So despite price cuts, and then this whole explanation. So hopefully other institutional analysts will listen to this. But if you're a retail investor, this is one of the shows that you cannot afford to miss because Jeff is just nailing it every every Monday. He shares great information. Thank you, Jeff, for choosing to share that on my channel. Folks, follow him on Twitter, on X at the Jeff Lutz. He is really just a wealth of info that you can't find anywhere else. Thank you, Jeff. Appreciate you.
Thanks, Herbert.